I'm Aaron Rubin, your financial advisor. I'm really excited to bring you the news of the first quarter of 2015. It turned out to be a decent quarter, and it's always good to start the year off on a good foot. So, aside from looking over what happened in the last quarter, we'll also talk about bulls and bears and why you shouldn't predict the market, but a little bit more into the data. Hope you enjoy. 2015 began as 2014 ended, roller coastery. But that's the way the market works. Let's take a look and see what happened. And so, in the first quarter of 2015, the US REITs did very well, just like they did in 2014. US Small also did well, under 4.5%, but finally, international came back to life, and it finally paid off to be an international, with the international small cap returning a little over 4% and the international large value over 2.5%. US large still was positive, up almost 1%, and the bonds lag behind. Again, the bonds are meant to bring stability to the portfolio, so we wouldn't expect them to move very much. That being said, being in a 65% stock, 35% bond portfolio got you a little around 1.5% over the last quarter, which is not too bad. So, what really shook things up in the market this first quarter of 2015? If we take the Yahoo Finance headlines from that first quarter and we put it into Wordle, which pictorially depicts the most popular terms used in those headlines, we find that oil is the thing that looms the largest. And that's not surprising. We saw a big drop in oil this first quarter, again, which fueled some fears, also some hopes. Not to say that it's a predictor of how markets move, but again, one of those things that did indeed have an effect on the markets. And March 9th of 2015 marked a very important anniversary, and that was the 6th year that the bull market has run since the bottom of the bear market in the 2008-2009 crash, which has a lot of people worried about the next crash. The downturns can be short and severe, and the recoveries can be long and robust. So having a 6-year bull market is not the end of the world, and it's not a telltale sign that the bull market's ending. The answer is we simply don't know when this bull market is going to run out. We saw in the 1950s there was a bull market for 181 months, which compared to now, our current bull market at 73 months is half, less than half, of what that particular bull market was. But as we see throughout this graph, sometimes they're longer, sometimes they're shorter. You never can really tell. From a historical perspective, and of course history doesn't predict the future, what we find is that the average downturn is around a little bit over a year, and the losses contained in those downturns, in those bear markets, is around 28%. Now, to make up the ground that you lose usually takes around 24 months of bull market to recover it. Now, as I said, that doesn't indicate what's going to happen tomorrow, next month, or next year, or over the next 10 years. But we do know is that markets tend to go up over time, despite the fact that there might be some downturns along the way. And how do investors typically do during up and down markets? The answer is generally not well. The problem is when the average investor goes into the market is typically going up, like we see in the beginning of this graph. The problem is when the market starts to go down, people bail very quickly. And so we look at April of 2009 when the market was near its bottom, we see money is just fleeing all over the place. As the market starts to recover, people have missed the bottom, then they start putting money in. But then we look at things like 2011 where we saw just a little blip on the radar, which people thought at the time may have been the end of the world again. And again, money fled the market. So again, investors make poor market timers because market timing generally doesn't work. So what can we learn from all these bull and bear markets? The answer is do more of the same. Keep diversified, keep disciplined, keeper balancing. None of those things will guarantee gain or guarantee against loss. But over time, when markets tend to go up, you should be trying to go up with them. Peter Lynch said it best. More money has been lost trying to anticipate and protect from corrections than actually in them.
So, what we see is what we've always advocated, and that is not trying to time the market. You don't know when the next bull is going to come, you don't know when the next bear is going to come. So, best not to try to predict it all. Best of success in the upcoming quarter. Thanks.